Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Well, hello, everyone. Thank you so much for tuning into the Millionaire Next Door podcast. We are thrilled you're here. We think this will be a real good use of your time. We are going to continue down the educational path of infrastructure and why that is so fascinating. We've had a few terrific conversations about that in the past. March 18th of 2025, we had an introductory discussion, and that was really helpful in episode 69. And in episode 78 on July 28th, we had Michael Underhill, a portfolio manager in that space, really get it into the whole demand side and what's going on. When we started to wrap that up, there was so much more to cover. So we invited Michael back. He's here with us today. And we're ready to launch into this. Michael, how are you?
Doing great. How was your summer?
The summer was good. I'm in San Diego today, if you can believe that. So I'm trying to not give up my summer, but I'm working from here. But it was good. It was really nice. And I'm a big tennis fan. So right now you've got the U.S. Open going on. It's September 5th. But how about you? How was your summer?
Fantastic. Lots of travel, lots of visiting with family and friends. And, the race for the end of the year officially started right after Labor Day. So things are busy, but it's a good kind of busy.
Yeah, absolutely. Interestingly, you had sent me a stat. I think we released our last podcast, episode 78, on July 28th. You sent me something saying, coincidentally, on that day, if I'm not mistaken, power demand in the continental United States reached a all-time record. That was an attention getter, right? I know it was pretty hot throughout the country, but talk a little bit about this demand, that sort of hockey stick nature of how this is accelerating. Love to hear your thoughts.
Yeah, I think, when I look at that, specifically that day, the statistic that I sent to you, I think really what's going on is it's a convergence of things. And specifically, July 28th of 2025, the continental U.S. shattered its electricity consumption record by using roughly 758,149 megawatt hours in one single hour. That's enough power to power one home for 70,000 years. And it wasn't a fluke, it was a signal. And it was signaling what we're seeing is a new era of sustained energy demand. And it's driven by multiple things. It's not just the weather. It's not HVAC systems or a heat wave. It's the rise of AI-powered data centers. It's the electrification of transportation and manufacturing. It's the reindustrialization and onshoring of supply chains. And to your point about the weather, there is climate-driven cooling and heating trends. And if you look at electricity demand, it's forecasted to grow 25% by 2030. And that's less than 5 years away. And if we were to look out to 2050, it's forecast to grow 78%. Just in the US, electricity demand will grow 78% by 2050. And this is a report cited of the stats I'm throwing out here by McKinsey. And they were confirming the trajectory, citing more than 3% annual growth through 2040. And when you look at these kinds of numbers, they're just mind-boggling, right? But when you look at it, as someone who's been investing in infrastructure for years, I look at it as infrastructure is the backbone of this energy transition and the increased demand for electricity to all of these factors, right? And the surge of demand is going to require massive investment in infrastructure. So think power generation, renewables, nuclear, nat gas, transmission. Think big power transmission lines and grid upgrades. And then also think about some of the digital infrastructure, some of the things that are going on in data centers and fiber networks and artificial intelligence and robotics, pulling on those systems. And when we look at these types of things, and you layer in all of these statistics, it leads us to this sort of technology driven expansion. And as artificial intelligence, every day, every week, every month, it continues to evolve towards a persistent coherence across domains. It's not just optimizing infrastructure, it's reshaping the very laws of emergence. And I think when you look at investing in digital and energy systems now, it means anticipating behaviors before they materialize. And it's creating an interesting investment landscape.
Yeah, absolutely. I mean, we are in a technology dominated era that's been going on for a while. You had shared with me another just factoid. I guess I'll call it a pretty big doozy, but as I recall, you said year-to-date capital expenditures in AI, defined as investments in information processing equipment and software, have contributed more to GDP growth than consumer spending.
Correct. And what you've seen, go ahead, I'm sorry.
Somewhere in the back of my mind, I've got this stat that says consumer spending is like the largest driver of the economy. So maybe now there's a new boss, or is that, go for it.
There's a new sheriff in town. You're absolutely right.
Sheriff in town.
And artificial intelligence drove that 3.3% US GDP print. And so artificial intelligence spending has now officially eclipsed the consumer in driving the economy. And if you, I don't know if you've been looking at any of your socials, but on X, they had a couple of different video clips in which all the heads of technology companies, you look at Meta and Google and all the new Mag 7 Plus companies like AMD, all gathering in the White House around a table, talking with the current president about what's going on in technology, rapid adoption of AI. And the spending, Mark Zuckerberg just dropped a stat this morning on X that he's spending $600 billion on AI. Just one company, Meta, is spending $600 billion on AI. And so the private sector capital spend is driving this momentum in GDP growth, causing those two hot GDP prints, driving the economy in July and August. And as we move through September, you mix that with a job report that was pretty sobering this morning, quite candidly. And so artificial intelligence spending by large private sector companies, it's driving the economy and creating more opportunity. And it's changing the way that the U.S. economy is actually functioning.
Yeah, it is. It is. That makes a lot of sense with that kind of spend. Talk about, maybe you can give us a little insight when you say infrastructure and what you do, as opposed to just getting the Mag 7 or these AI type companies. It's obviously a lot more than that. You've created the case for massive demand, and that's not going to abate possibly in our lifetimes, right? So I'm just curious your thoughts across all this and how you're approaching it.
Yeah. So in the last 33 years that I've been in the investment business, you've seen infrastructure change and morph from various sort of capital structures and assets where it used to be considered stodgy, sort of low growth, low income producing assets. And it's become a larger ecosystem driven by these three big megatrends. You think about AI and how that's a megatrend. There are these three big megatrends that are driving the total addressable market share within infrastructure, which is right now total addressable market share is about $3 trillion to invest in infrastructure. But first big megatrend, energy transition. Think about the shift from coal to natural gas in 2001, 2, 3, 5, through 01 through 05. And then from 05, the rapid adoption of natural gas fired generation, complemented by solar and wind, renewables, nuclear, hydroelectric, and battery storage. So that big energy transition and the need to generate more power and electricity, that energy transition megatrend is a 30 plus year trend. And some of the stats on electricity I rattled off just a few minutes ago. that trend is accelerating. We need more electricity and power generation. You need multiple sources of power generation. It's not fossil fuels or renewables. It's fossil fuels, renewable, it's nuclear. It's all these new technologies to generate more power and energy during this transition that's going to last over 3 decades. And we could talk about sort of the science application of power generation and some of the things that are cutting edge in the space. But I think that investable opportunity set is north of it's north of call it $3, almost $4 trillion energy transition. Second big megatrend, digital transformation, AI, robotics, the fourth industrial revolution. We're seeing it happen right before our eyes. And you're seeing things with data centers and towers facilitating data centers with AI, but also communications, computing. Spent time on the phone with, actually virtual with a very successful executive that was with Apple in the early years. And he's working on a new chip that uses 1/10 the energy and has 9 times the compute power, right? Just fascinating technology. And there's knock-on effects within the data center world. Think about within digital infrastructure, the towers, and investing in cell towers in a world in which you're in downtown San Diego. What I would say to you is, Robert, pick up your phone and look at it right now. And are you in a 4 or 5G area?
Let's see. I'm in a 5G area.
So you're in Del Mar in 5G. Mm-hmm. I was in La Jolla in July in a major office building, one of the La Jolla Office Park. I was in 4G territory. So the build out from 4 to 5G, mm-hmm. It's not completed in the United States.
Right.
Think about that. So that's still continuing with both small cell towers and some of these larger towers, and that'll continue for the next few decades, complemented by fiber. And you think about fiber optic lines that are spread throughout the United States. There's dark fiber, and there's and more of this fiber will need to be lit up to accommodate technology, to accommodate communications in this digital transition. And last but not least, satellite. When you look at satellite companies, whether you're talking about Elon with Starlink or any of the other satellite companies that are out there, there are multiple applications for not only communications, but think defense, security, redundancy to land-based and cellular-based communications. So that digital transformation, again, 30-year plus trend, where there's trillions of dollars of capital flowing in that space for development and the build out, where by 2050, 74% of the infrastructure that's going to be in this country hasn't been built. 74%. So we're going to build all of it as we go. And the third big megatrend, enhancement of aging infrastructure, think airports, seaports, toll roads, existing infrastructure that needs to be optimized, repaired, enhanced, and maintained. And we were talking about this earlier about trains in San Diego. There's almost this continuous phase of construction. And if you look at things like rail, right now, if you just look at U.S. rail transport, preponderance of that rail transport is commercial. And you think about all of the freight rail, of which there's millions of miles of it in the U.S. It's low speed, 40, 45 mile an hour rail. And we don't have the rail infrastructure in this country to be able to use passenger rail like they do in China or Japan or other countries, even like Europe. Because commuter rail is typically high-speed rail.
There's a lot going on there. And by the way, I think I shared with you on our last podcast, just anecdotally, I got a lot of really good feedback, but a couple that really stood out. Somebody I work with, they actually, it's pretty blue collar type business, but they run a business and they clean power facilities, nuclear facilities, all kinds of, literally the manual. Somebody has to, so they, obviously you can't, it takes forever to build a new one. It's exceedingly expensive. So keeping the existing ones tuned up, well, their business has really taken off. They're seeing orders like crazy. Another comment that just sort of someone reached out to me, you talked about the carbon recapture. Someone I work with shared, hey, what Michael was talking about, we're seeing that all over the place. They have instruments that measure chemical properties and hydrocarbons and stuff like that. They're all using that. And he said, we have 4 or 5 facilities, just like he was describing, already in place. So it was really interesting to hear how that spans down, just get that kind of feedback. So we're obviously in a mega trend, and that's exciting. Talk about what you do and how, I guess, share your wisdom on the best way to position for this. I'm sure it's a diversified, maybe you feel like a kid in a candy store at this time, I don't know, but how do you decide how to do allocations and prioritize? And talk a little bit about that process, if you would.
I think, when you look at investor portfolios, our perspective, I break it up into wealth management and the institutional world. And then you have these sort of individuals that are, individuals, whether they be ultra high net worth, massive flow, they're trying to emulate what the smart money's doing in the institutional world. Pension funds, endowments, foundations, sovereign wealth funds. And if you look at what the institutional investors have been doing in the last 20 plus years, they've complemented their stock and bond allocations with real estate, private credit, private equity, and infrastructure has been a key component, 10% allocation in institutional investor portfolios for at least 2 decades. And what you're seeing in now the wealth management channel, whether you're talking, 10.6% of the U.S. population are accredited investors, the rest are mass affluent. There's an increased demand for alternatives, and there's a resonating theme that the needs of these investors have become more sophisticated over time, and it's also being driven by several themes driving the demand for alternative investments within a individual investor portfolio. Number one, the theme of growth. Think about the ability to capture liquidity premium through private and less followed, less understood portions of the markets. You're being able to potentially profit from opportunities outside of the traditional, stock and bond capital markets in both expansionary as well as volatile market periods. You saw some volatility today. So growth is one of the big drivers in the demand for alternative investments like infrastructure. Secondly, the driver of income, generating income in challenging interest rate environments, capturing an illiquidity premium that often results in attractive ongoing inflation-protected cash flow. And it produces also an income with non-directional sources of yield. So think about 20 and 30-year power agreements. Think about 20 and 30-year different contractual cash flows within infrastructure assets that are producing those non-directional sources of inflation-protected yield. And last but not least, diversification. I'm sure you hear it all the time. We're loaded at the teeth with NVIDIA stock. We've done quite well. We need to produce, maybe harvest some of those gains, produce some uncorrelated diversified sources of return. Add in infrastructure, a 10% allocation, mitigate some of the risk by adding diversifying investments, relatively low volatility or low correlation to your existing stock and bond investments, as well as that diversification, having a hedge against inflation to protect against rising rates, but also potentially, the Fed's talking, there's a whisper of a Fed cut with the jobs report this morning. I think, we're all in agreement rates may go lower, but inflation sure is not, it's not going down. And we're seeing structurally higher inflation, whether you're talking college tuition, medical inflation, wages, even commodity input inflation. And so inflation's taking many forms in the form of that sort of cost push. So diversification is that third driver. So think growth, number one, income, number two, diversification, number three. And that's the driving the investor to seek out alternatives and add infrastructure in to complement what they may already have in real estate with a differentiated return and infrastructure, differentiated, very different income stream. It's inflation protected. And, there are clearly trade-offs between private equity, private credit, infrastructure, and real estate. They all have different volatility profiles, different risk return attributes, but not unlike a symphony. If you have a horn section, you have a string section, all of these things work in concert to produce beautiful music. And within your portfolio, potentially can provide you with a better outcome using these types of alternative investments incorporated to a portfolio.
Yeah, there's so much going on with. Do you have thoughts on interest rates with if there is a downward trend, how that affects things? I mean, I do agree with you, by the way, on inflation. And, I'm thinking with this massive demand and this need to make all this happen, these businesses that sell this or entities that provide that, there's no reason for them to discount anything. That's just going to keep driving the prices these higher as massive demand is out there. But kind of a two-pronged question, and I guess infrastructure and alternative investments really do drive down correlations. Yeah, let me let you answer that or give us some thoughts on that.
So when you look at lower rates, think about refinancing and discount rates. Lower interest rates provide a lower discount rate for financing the projects.
Mm-hmm.
And whether you're talking about data centers, airports, seaports, toll roads, pipeline operating companies, whether it's energy, digital, enhancement of aging infrastructure, all of these projects become a little easier with a lower rate, and infrastructure does benefit from a lower rate environment and provides a little bit more of a growthy return within that cycle of a marginally lower rate. We're not going to zero anytime soon in terms of interest rates, but a marginally lower rate provides a little bit more growth opportunity within infrastructure. So you're going to see returns trending higher over the next rate cycle. Conversely, when you saw rates that were ticking up, things that were, the long-term 20 to 30-year power agreements were much more attractive. But that's why over various interest rate cycles and various economic cycles, because I think we're in for what may be a decelerating economic cycle, you need a diversified portfolio of infrastructure and private infrastructure equity, private infrastructure debt, multiple sectors, well-balanced diversification. So you have a well-balanced approach to portfolio management, and that way you can manage for better outcomes.
Yeah, I really want to emphasize sort of that diversification theme. We touched a little bit on our last conversation, but equity values are probably somewhat stretched, pretty rich, PE wise and whatnot. The other enormous factor going on is just this massive concentration of so much concentration in so few names. Even the S&P 500, I think the top 4 stocks might be 25% of it, on the at least on the cap weighted. And so if we do see an economic downturn, it used to be bonds and these other things diversified you out, but not that much. Everything becomes highly, highly correlated and everything moves the same way. And so even small allocations to these alternative investments can make a really big impact, in a down market or a decelerating economy. So I just think it's very timely, especially given the massive demand. How are you viewing that?
I think when you look at infrastructure, historically has that downside protection because of long-term contracts that are inflation protected.
Mm-hmm.
You've got essential companies, assets, services. Said another way, whether you're in a financial recession or depression, like think the global financial crisis back in 2007, 2008, 2009, people continued to flush their toilets and take showers and use the lights in their homes. And so that recession-resistant asset class, said another way, private infrastructure, typically generates anywhere from 10 to 11% annualized returns. And from 2014 to 2024, from 2004 to 2024, you saw infrastructure generate a 10.7% rate of return, private infrastructure. And the volatility was roughly about 3.9. So very low vol, certainty of cash flow, inflation protected, contractual cash flows that have a small element of capital appreciation. So 10 or 11% doesn't sound really attractive to a lot of investors. But if you run that chart over at that 20-year time frame, 2004 to 2024, it's actually pretty attractive. And to your point about correlations, private market infrastructure has a very low degree of correlation to the S&P 500, very low correlation to investment grade bonds. And we've seen it over full market cycles, 5, 10, 15, 20-year cycles. So I think that's really what's really driving the allure of the asset class to be incorporated in more client portfolios.
Yeah, I mean, 10 to 11% sounds pretty compelling. If you look over, in a normal investing cycle, you can do quite well. I assume that comes with more stability versus just being in equities, it's a lot lower drawdown if there is a downturn. Is that your historical, or what do the facts say about that?
Yeah, that's what. So during the 07, 08, 09 GFC crisis, you saw infrastructure was probably a -2. That was the biggest drawdown over that 3-year time frame. When you saw equities just got destroyed, we're talking -40, 50, 60%. The snapback in equities, from that trough in March, we'll call it that last week of March of 2009. The snapback was a violent snapback where public equities rebounded. Mm-hmm. Infrastructure didn't rebound like that, but conversely, it didn't suffer the downstroke during those years in which you were in mass liquidation phase during the global financial crisis. So something that provides a little ballast to the portfolio, provides you with some modest growth, some nice inflation protected income, and provides a diversifier to the portfolio. It's complementary, not replacing things, and that's what we're seeing. A lot of the wealth management channel taking a 5% allocation of their large cap equities, taking a 5% allocation out of their fixed income, reducing their public markets volatility, then they fund a 10% allocation to private infrastructure.
Yeah, that makes a lot of sense. A 2% drawdown in the global financial crisis compared to the carnage we saw everywhere else. Yes, there is a violent snapback typically. We've seen it a few times recently. We saw it, with COVID and then just the tariff stuff back in April. But I get concerned that some folks will snap out of that or get too worried or exit. And then sometimes these snapbacks are so quick and so strong that they won't be back in, or they might just be afraid to go in and they're out of it. So they can really, really, really hurt yourself. So if you just ride with that for a longer term and you don't have the drawdowns, not to mention when the drawdown is so much smaller, you really don't have to be up that much to recover. It's pretty doable. So those are really powerful factors and good things to think about, coupled with the massive demand. This has been a fascinating discussion. Do you have other thoughts or ideas you want to share before we let folks go for this time? Just curious.
Well, I think diversification is your friend. To your point, stay fully invested. Have a plan, meet with your advisor, make sure all of your sort of tax planning, investment planning is in place, but always stay fully invested. Revisit your plan frequently. Spend time with your advisor working on your diversification and making sure you're adequately diversified and have diversification within your portfolio. So you don't have duplicative assets or highly correlated. I've seen client portfolios where they said, I'm going to DIY. I'm going to do it myself. I'm going to go to Vanguard or BlackRock and buy a bunch of ETFs and try and build an asset allocation model. And then what they find is during periods of liquidation, whether you're talking global financial crisis or even tariff tantrum of 2025, all those ETFs, because so many people are holding them, they go into mass liquidation. And so whether you're in large cap growth or large cap value, mid cap growth, mid cap value, small cap growth, small cap value, when there's a liquidation, it's an indiscriminate selling, and the ETFs go into mass liquidation. So everything draws down. And as you get further down that cycle of liquidation, we saw it in April, everything's correlated because it's liquid equities risk. So having alternative investments, infrastructure, plus your private credit, your private equity, private real estate provides you with a little bit of diversification and a buffer. And it increases your Sharpe ratio, your risk-adjusted rate of return. So you can stay fully invested across liquid and illiquid and semi-liquid structures as well. So you can have better diversification and better income generation, because the world which we live in today, there's still a global hunt for yield, for income, and enduring sources of income that are not correlated to bonds. So I think that's the real stay invested, but stay diversified, and spend time with a qualified advisor that actually can identify some opportunities and not just sort of adopt the models from an ETF provider that may or may not have your personal considerations incorporated into your portfolio construction.
Yeah, that's really good. I mean, that's what we do all the time. It's these check-ins. I don't know if people are aware how concentrated things are right now and how that just keeps expanding, possibly to the highest level we've ever seen in history. And when things don't go the right way, they're all connected. So adding some other things that help diversify out or that are more stable, that's an important conversation to have, especially in an economy like now with, a lot is changing. So much is changing. So folks, reach out if I can be of any help in that respect. And we will continue to reach out to partners and folks, really smart folks who provide good solutions that can help educate and share thoughts, really share wisdom. You mentioned being in the business 33 years. Well, that's a lot of wisdom there. So we're looking, I think people want wise counsel, in a very uncertain world. And we appreciate being with us, Michael. And, we'll have you back because it's just too fascinating. And didn't know if you had any final closing thoughts, but other than that, we'll kind of sign off and wish everyone a great day. But please feel free to have a good closing last word if you like. Otherwise, we'll see you soon.
I think just a parting shot, I would say if you just look around, whether you're talking about AI, energy, digital, anything that you pick up your cell phone, you read CNBC, Wall Street Journal, Financial Times, it will point you that all roads will lead to infrastructure investing. And I think what you're finding more and more is that it's not a nice to have, it's an essential and contributes greatly to portfolio diversification. And I think that's just the parting thoughts that I'd leave with you and your audience.
Well, that's great. Hey, thanks again for being here. And thanks to everyone for tuning in. We're going to continue to find interesting topics and just share info with you and help educate. And feel free to suggest any topics, or if you have questions, I'd be happy to address them. Please feel free to like or share this with family, friends, whoever, anybody you care about, and make it a great day.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors or Royal Alliance Associates Incorporated, member FINRA SIPC. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.